Like not sneezing when you have to sneeze is like
trying.
Not peeing when you have to pee.
It's gone.
Oh my! You know how bad that is for you?
I know.
Gosh.
Yeah, basically, I just took 5 minutes off my life. It's gonna suck.
I mean, what do you do when like if you have to sneeze but you didn't sneeze? I know it's supposed to be really bad for you.
Well, it never got to the point where it was like where I'd started to sneeze. It was just that that feeling like in my nose, you know, where it's like that tickle where you're like,
so you're probably fine
waiting
then.
for like the rest of it to catch up, and then just
you're probably fine then. I mean, if you really needed to sneeze, your body would have been like, get out of me, because apparently when you sneeze,
it's
chemicals
faster
leave
than a bullet's fired from a gun. Usually, it's quite
okay. Well, see, there you go. See, that's what I mean. That's how bad your body doesn't want that thing to be in your body.
It's both more and less violent than food poisoning.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
And welcome back to yet another presentation of Drunkenomics. This is the drinking podcast with an economics problem. I, for like the millionth time, it seems like, am welcoming us back as the less gracious host. And if it's your first time, welcome for the first time. But I'm your less gracious host. My name is Aaron. So glad you all can join us. And of course, I'm joined alongside the guy that keeps bragging and doesn't just say.
Absolutely not.
What was your name again?
I am more gracious host James Goldwater.
Yeah.
For I don't know, it's too long. It's weird. I don't know how I feel.
You're the more gracious host that doesn't put too many bitters in their Manhattan like I just did just a moment ago.
Sometimes I do just to bring myself down.
Wow, why? I mean, I'm just gonna put some more rye in here to
a little more whiskey on that.
Yeah. I'll put some more. I'll do a little bit of both. I'll put a little bit of vermouth in here too. But yeah, so glad you all can join us. If you don't already, check us out on social media. We have a lot of stupid, I think actually smart alecky, I would say, stories and tweets and all that kind of stuff. You can find us there on Facebook, Instagram, aka the Metaverse, and Twitter at Drunkenomical, DRUNKENOMICAL. And then from there, you can also hop into our Discord. We have a lot of good discussions, such as Buffalo asking us, what is our definition of rich?
Oh, yeah. No, it is. And I love, Aaron, your response there, which is essentially just a positive net worth, which, that might be a hard find when we start talking, but once we get to the nub of tonight's episode.
Yeah, exactly. Seriously. But before we get into like the real nub of the episode, and also
a real topic of discussion.
Yeah. I got a question for you, James. It actually doesn't come from our Discord or our Instagram or anything like that. But my question is, there's been a lot of talk about this hawkishness and all that kind of stuff with Bullard coming out and saying whatever he's saying. And then inflation seems to be the big news headline. Recession is the other big news headline. And sorry for taking forever to get there. But my question is essentially, do you think if there was a more hawkish tone from the Federal Reserve, would that actually help things like the real... Because I think the real problem is like supply chain concerns, food shortages.
So that's
bottlenecks at the ports.
I would say yes. I think that they.
Yes, as in you think this? Do you think?
I think we need a more hawkish approach. Yeah, I do.
But would
think
it help
we need
those
that.
things? Do you think it'll actually?
help
no!
Heavens no! Those things need.
Okay.
The Fed has taken an approach, or seems to take this approach, that dovish or hawkish policy is a blanket cure-all. And it's failed to observe that it needs to target specific sectors and take specific actions. And
absolutely,
I think the real problem is that's not specifically speaking the purpose of the Federal Reserve
or the Treasury. Because the Treasury just based on some headlines that I've seen and some of the articles that I've read, it seems like the Treasury is trying to take on this food shortage head on, which I'm like, I don't know if that's your guys' job. I don't think it's in your job description to solve food shortages.
Yeah, well, there are theoretically programs and powers that the executive controls, and all the departments answer to the executive. So
of course,
theoretically, it is under the purview of the executive to target specific crises and deal with them. Within the bounds of the law, or essentially, or within the bounds of presidential prerogative, if there's no law specifically telling them they can't do what they want to do. Because that's a really fun thing.
Yeah, because government controlling food supply, that sounds dangerous, man. That sounds really dangerous. And usually it hasn't worked out. So,
well, generally what you're looking for is you want the government to go in and do something to allow easier exploitation and access. Mm-hmm. So let's take the example of energy, which is certainly causing some issues with part of the inflation problem.
A pretty big part.
The executive branch has decided that they're going to start doing leases to oil exploitation in on federal land. And I know that goes against one of the campaign promises. And is it going to solve the current problem? Absolutely not.
No,
it's going to take several years before that even begins to be a twitch. To affect the supply, but it is an act taken to affect the long-term view on energy.
But a lot of times what that does is it cools commodity markets down, which when it does, it can bring the spot price down of oil, right?
It tells everyone that the party they're at, it tells them specifically now you are playing a game of musical chairs.
There you go, and it's winding down.
And we're changing the song.
Pretty frequently,
we're not stopping it, but we're changing the song, and we're letting you know if you're left holding the bag at the end of this, you could be a little unhappy.
Yeah, so it's that, and then on top
of your jets.
Yeah, and then on top of that, they also announced that is it 1 million?
They're pulling
1 million barrels per day of the reserve, the strategic oil reserve.
Yeah, strategic oil reserve. So I know that I don't remember the exact amount they're pulling out, but I know they are pulling out. They are. I thought
it was 1 million a day, which like in the grand scheme of things, that's like what, maybe 3 or 4% of like our U.S.'s daily consumption of oil. It could be even 5%. I would say probably like 5% of our daily consumption of oil. But I mean, still 5% is a lot. It's 1 million barrels a day. So, I mean, it could bring down prices, but I don't think it'll do it immediately. I think these are just actions that they took to kind of cool the commodity markets and the derivatives.
Yeah, it is 1 million barrels a day. And it is, it's onto the open market. It is an attempt to cool down these red hot commodity prices. Because you were texting me today, like you were pointing out that corn is up 9% or something.
Corn is at all time highs. I think they're at all time highs. I'm like 99% certain that they're at all time highs, which is bad for bourbon
and therefore for us,
especially us.
And the thing is, when one commodity starts to run away like that, especially when it's a commodity that has a lot of it's a base food product like that. So if silicon,
but they feed cows. But they feed cows with corn. They produce ethanol. I mean, this corn goes into so many different things that it's like
so it's
just
huge
corn
in food.
Itself goes up.
It's huge in food, and it's going to affect energy as well and the gas. Yeah. Think about this. So it's going to drive up the cost of
livestock too. Like think about how it's going to affect livestock.
Oh yeah, it's going to drive up meat prices. It's going to drive up all food prices across the board because eventually people are going to stop buying corn for certain purposes and they're going to buy wheat for certain purposes. So it sounds weird, but wheat's going to be up too because wheat's also got another problem.
Shot up like crazy today too. So which is not good for Scotch. And rye. So.
Well, the reason wheat's up is between Russia and Ukraine, they produce a not insubstantial amount of the global supply of wheat.
Yes,
and 2,
and vodka.
I don't know if you've noticed.
But vodka and wheat. But
that's what's causing potato prices to rise. I don't know that to be true, but I have to suspect it is.
I have a sneaky suspicion that
so corn's up. So corn is up probably because wheat's up. It's probably the other way around. It's that we're seeing a huge restriction in wheat supply. Okay. So you're gonna see corn prices go up because of that. Because it's a substitute good, corn and wheat. Essentially, they're both grains that can be used for. I mean, not the same things, but people will go back and forth between them.
There's a lot of crossovers.
There's a lot of crossover in a lot of industry, agricultural industry specifically, obviously.
Yeah,
but then
I just looked it up. They're a 9-year high, so I'm a little off.
Well, it's all time for some people.
That's true.
Then I'd say right now the weather has been very strange this spring. Yesterday we were going to Easter. I woke up in the morning and took the dogs out, and it was snowing.
It snowed up there yesterday?
It didn't stick, but it was there. It was snowing.
That's crazy.
It was that flurry snow mix in the morning, and I was like, "Where did this come from? Why is this?"
That's weird.
So corn usually doesn't plant until a little bit later because you want to see you have to see the last frost. You don't want to see too much rain.
Yeah.
But if you've got corn farmers who are looking at weird weather phenomena, they might be sitting here going, "This may not be a great year for corn.
Let's plant something else.
I'll plant something else so that I can get something in the ground."
Yeah, but the weird thing is, so like I could see where you're coming from, but when I looked at the commodity markets this morning, everything was up. Every sort of ag commodity was up.
Well, think about this:
So,
if you see that
that was the only one that wasn't up.
Well, if you see that, so let's say I'm a farmer and I've got land that can grow corn or wheat, and I see that the two countries that export a huge amount of wheat to the world are now at war, and that wheat's and one of those countries can't ship because no one in the West is buying, and the other country can't ship because it's being invaded. Yeah. I might sit here and go, let's grow some wheat this year. Why grow corn?
Yeah.
And then you got these other guys, a lot of people are going, ooh, okay. So you're seeing farmers kind of shifting around what they want to grow. So that's going to affect commodities because you have people who are changing things out.
That's actually a really good way to look at it because I never thought about it in that sense. All I saw this morning was corn is super high. Corn has gone through the roof.
Well, let's just say, let's say you're a farmer and you've got a field and you've decided you're going to, instead of growing all your fields of corn, which you're probably still going to grow some because you've got maybe futures contracts, or you just know you need corn, or you know corn, so you're deciding, I'll take a risk. I'll grow 2 fields of wheat this year. I feel
like you got to be making money either way. Well, whether you actually grow the thing and then you sell the futures contract. I don't know. I don't know how it works, but like you got to be making money either way.
Oh yeah.
In that business,
of course.
The markets are wild.
Of course, but I'm just saying, as a farmer, you might be sitting here going, maybe now is a time to diversify what I'm growing instead of growing just one crop.
Right. Yeah. Or profit margins are higher in this one instead of that one.
So I'll push into it, but I think everyone's going to push into it. So I'll hedge my bet.
Yeah.
Yeah, so I think you're starting to see some farmers take some risks. I think you're seeing them look at weather and they're looking at things going, oh man, maybe this is the year for corn. This is not the year for corn.
Yeah, and
as for soybeans, I don't know.
I don't know anything about soybeans either. But if you're long commodities, congratulations in advance because pretty much everything went up today. As far as energy, ag futures, metals, everything went up today.
Oh yeah, no. Look, we're seeing a supply shock to the left in certain things, which is forcing people to reassess the price points they're willing to pay at, and so they're moving out of one commodity into a substitute good. And I think that's starting to ripple everywhere. You throw that rock in the pond, and it starts to go out, and eventually it hits the banks, and it starts to come back in. So now the ripples are. How are they affecting each other? And that's, I think, what we're starting to see. So when you asked the question earlier, kind of, what does a hawkish behavior do to this, to help with this? My response is, I think we need to see hawkish behavior in a lot of markets, most of the market. I think when it comes to the supply chain, I think we need to see the governments stepping in to prevent predatory practices by trucking companies against the truck driver, against the Teamsters themselves. We need to see things done to encourage Teamsters to be out there working. We need to retain Teamsters. It needs to be a profitable business,
of course,
or you're going to have a problem, and it can't just be profitable for the business. It has to be profitable for the actual drivers. Right. Otherwise, they're not going to do it. And so you got some things there that need to be addressed.
Yeah, but it's just
when that calms down. I think when you get fuel prices under control, which that's not really within the power of the president of the United States.
Yeah, but the thing is, my thing is this hawkish tone. I don't feel like it's aimed to solve. I don't think it's really necessarily aimed to even consider supply chain bottlenecks, and that sounds really ignorant for me to say. And so just let me explain myself real quick, because the dovish tone was really geared towards financials and equity markets, which didn't need any help to begin with, but for some reason it flowed into a bunch of other things. It flowed into NFTs. It flowed into a bunch of reasons why people didn't need to go back to work right away.
Yeah, if you give if you give people free money, they will start to spend it on stupid things eventually.
Yeah, and sometimes people will do pretty well and they won't need to go back to an actual job, right? And it's kind of like going, when I showed you that clip of Josh Brown on CNBC that I was dying laughing at. I was just like, this is so true. There's a bunch of people without jobs trying to pay rent by trading NFTs. And I'm not saying NFTs. I'm not saying NFTs are the reason why there's supply chain bottlenecks, but I don't think they've helped at all. Not. But they haven't helped. We can all agree that.
Have they hurt the situation? No. Have they helped the situation? No.
Absolutely not.
It's a non-issue. I look at it as a non-issue. It's okay.
But if you add up everything else, like the Dogecoins, the AMC GameStops, all that stuff, right? None of that stuff. I don't necessarily
blame someone for if you actually look at what being a long haul driver is, when it's like, oh, you lease the truck from the company that drives for you. They only pay you when you're driving, not when you're unloading or waiting for a load. They're not going to pay. You see this, and you're like, wow, I have to pay for all the maintenance on this vehicle that I'm borrowing from a company that isn't going to pay me.
Yeah, but it's still
for the parts of
the thing is being the fastest track to being a millionaire is still being a truck driver in the U.S.
Is that, and then septic tank work and
and plumbing and all that kind of stuff. But they did like a poll and they're like, okay, I think CNBC did it. And it was like, what's the fastest track to being a millionaire? And everybody thought it was going to be like doctor, lawyer, or whatever it is. But no, it's being a truck driver.
A lot of upfront cost and time.
Yeah, exactly.
It is being a truck driver. And it's specifically, I would say, is if you're a medium and short haul driver is where you're going to make your money, because you're driving a truck that you don't have to maintain. Right. Whereas when you go to long haul, that's where you have to maintain the vehicle.
I don't know. Like apparently, I don't know, maybe the I mean, what was that company? Nikola? I think they were supposed to solve that issue.
Well,
and Godspeed to them. But yeah.
Rest in peace.
Peace. That's a little kind.
It's
but the thing is, like, the way I look at like the dovish or hawkish tone, it's like it just depends. It depends on what sector. Like, I think the hawkish tone will kind of solve the inflationary problems, and I think it'll kind of bring the balance to an equilibrium, if you will, in the financials. It's kind of like when people talk about real estate. Like when people talk about real estate, they're like, "Do you think there's going to be a housing crash in the U.S.?" And I'm just like, "But it depends where you're looking at."
Oh yeah, right? No, that's the real question. Is like, to me, it's like that great question from 2016 when people were like, well, how could the polls have been so wrong about the Hillary Clinton, Donald Trump question? And the response to that was, the pollsters were actually right if you look at the way they treated it. The vote played out essentially exactly as the pollsters thought it would. The problem was they took for granted it was a single election, not 50 individual elections. Right. So they looked at it and they said, oh, well, she should get 51% of the vote. She should win. Not 51. They said, oh, she'll get 48.9 or something. And he'll get 48.2.
Something along those lines.
So she should win, right? And you and I would look at that and go, yeah, probably. She would win with that. And then it's,
it
depends on where they are.
But I don't really want to get political because it's kind of like the Bush Al Gore thing, right? Remember when that happened?
No, exactly.
And Al Gore was more popular, but Bush won because of the Electoral College.
Bush won because of the Electoral College. And so that's what I'm trying to say is that question of, is there going to be one? The natural answer to that is the Al Gore, the Hillary Clinton popular vote numbers, which is yes.
I don't know though.
Well, then look at the nuance to say, well, actually, is it just going to be a real housing market crash in like New York, San Diego, San Francisco, Florida, DC, but like small town Beatrice is fine. So it's like, oh, while you could say there's a nationwide problem, that problem isn't necessarily everywhere.
No, exactly. Well, because like if you look at 2008, like there were certain areas in the country that got just annihilated by 2008. And then there were certain, like Florida, like Arizona, like Texas, like Las Vegas. Las Vegas got destroyed. But then there's places like Wisconsin, or I don't know if Wisconsin, but I know Nebraska didn't really get hit. Like there were people that worked in real estate around that time. They're like, there was a slight correction, but nothing too crazy.
Yeah, no. Prices here were never out of control.
Yeah.
So there wasn't a correction. They didn't need to correct, right? It was.
Well, the thing is, like, so I was talking to one of my real estate buddies this weekend. And I know. And like he opened my mind to like just another level of thinking because he's got like a bunch of PhDs. He teaches real estate finance at SMU, among other things. But he told me about like foreign investment into American real estate and how appealing that is to countries like Japan and Germany, which by the way have negative 30-year negative interest rates.
30-year rates.
So how appealing is it to buy real estate in the US when you have negative interest rates over there?
It's huge. So think about, remember when we were talking about China back at the very beginning when we first started this podcast, we were talking about so Donald Trump, when he was running for office, called it, there's a trade deficit between the US and China. And he's like, and the response to that is, well, that's true. But there's another thing you could call a trade deficit, which is an investment surplus.
Yes.
Right. Yeah. So it depends on what you want to look at. Are we selling them less goods? Yes. Well, that means they can't spend all their dollars. So what do they do with their dollars? They either buy their currencies to buy things from them, but that doesn't make sense. Or they buy assets in the U.S., right? And what are assets that are great to buy? Well, real estate happens to be one of those things. Equities, mortgages, right? All of this.
Bonds,
MBS.
Municipalities, right? So, or not municipalities, but municipal bonds.
Oh yeah, so, municipal bonds, munis.
And obviously, there's a list of things. I think there's like some sort of things that those Chinese state banks are allowed to buy,
they're not allowed to buy. They're not allowed to buy into certain places. They're not allowed to buy into certain things. But as a whole,
and then of course, I think they might have to pay some sort of like exchange, like foreign sponsorship fee or something like that for certain securities.
Yeah.
I'm not sure because I don't know rules in China, but yeah, basically, like if you spend $1 in China, like what do you think they do with the American dollar? Like they don't spend that in China. No. They have to spend it somewhere that accepts that American dollar,
which is the U.S.
Yeah. So I was going to ask, where do they accept the U.S. dollar? Oh, yeah, the U.S. So,
yeah, the main country. So it's not the only country where you can spend a U.S. dollar. There are other countries that have black markets where they only accept the U.S. dollar. Well, as a whole, we would say the only place where the U.S. dollar is really used is the United States.
And obviously, it's the Forex market, right? Like it's the most liquid, the most.
Well, it's liquid trading for liquid at that point.
It really is, but it's okay. Yeah, but so I guess it's extremely liquid. It's insane. It's more liquid than Scotch, but it's like the largest market cap. I mean, it's more the dollars get exchanged there more than anywhere else, right? Yeah. It's the biggest exchange. The Forex exchange is bigger than any exchange on the planet.
Yeah, the same bills or the same currencies are flying back and forth between. It's wild. We talked about it once.
Yeah, it's at an insane velocity. Oh yeah, and you can use a lot of leverage too, which is pretty fascinating. But yeah, I mean, speaking of real estate, I mean, this is like I looked at some numbers this weekend and I was just like, I don't know. I personally don't think the housing market is going to crash. It might come down a little bit, but I don't think it's going to crash.
I think it's due for a major correction. And it's due for that for multiple reasons. Now, will it be like 2008? No. And there's some big reasons. And some of the big reasons are that, or the biggest reason is that. So in 2008, when banks were holding bad product, and they had to maintain liquidity, and they had to, in order to do all these things, they would sell into the spiral just to get cash, which further drove down the value of the commodity. But they had to do it to keep in compliance. But that also, remember, it dragged down the value of the things they were keeping on their books. So suddenly they had to start selling. So it was a death spiral, right? Where you start to see this thing self-fulfilling. In order to maintain liquidity, they were having to sell product. And by selling that product, they were driving the price down.
Yeah, but that's what happens.
The rest of the product they were holding.
Yeah, but that's what happens when everybody's levered up.
Yes. So, now, the difference is that now it's not a requirement that they do that anymore. So they can't get as levered as they used to be, but they also aren't in a position where they have to sell like that. They can say, look, these are good securities. These are good properties. I don't want to sell into this just to maintain my liquidity. So there's new
reserve requirements.
Let's put it this way. They learned from the mistakes of 2008. And so they're not going to repeat that one.
But they can make new ones.
Absolutely.
Absolutely. Not beyond their reach.
In the immortal words of Ian Malcolm in Jurassic Park's The Lost World, the movie, and John Hammond goes, I'm not making the same mistakes again. And Malcolm looks and goes, no, you're making whole new ones. It's that idea. Do I think there's going to be a correction? Yeah, I think there has to be, because
I don't know though. I have a really tough time seeing it there. I mean, maybe in certain areas, but I just don't like. I don't think there's going to be a correction in Dallas, for instance.
Maybe not. There's three issues I think that are coming to head here.
Okay.
Issue one: for the last decade, there has not been adequate production of affordable housing. So the supply of affordable housing,
like home builders
are not building enough. They have not built enough homes. That's problem number one. For affordable homes.
Okay.
Which is people making less than roughly $80,000, right?
I hear what you're saying, but I don't.
Most people.
I don't see how that actually is going to bring the real estate market into correction. Is what I'm saying. Okay. But
so that feeds into the next two, which is to say, I was going to say that. There's one thing that might undo it, but what that brings us to the next two issues, which is to say, people who already own houses are fine until they want to sell and buy new ones, and low interest rates were great to drive these prices up. The problem now is prices are up so high, and now interest rates are starting to go up, that the vast majority of Americans have been priced out of the housing market.
Yeah.
And while
I agree with that.
And so when you have no supply of new housing, or very limited supply of new affordable housing,
listings. And no one, if you owned a house, why would you want to list it? That's what you mean, right? Like,
I mean, one, if you own a house, why are you going to sell it?
Good luck buying the next one.
Right? Good luck buying the next one, right? I can't afford to move out, because where am I going to go buy?
Yeah.
Right. So that's the problem for people that already own their houses.
Yes.
Then you've got no supply of new housing. There's no supply of new houses being built that are at affordable rates. So you've got people who can't afford to move in.
Okay.
And even if they could afford it, they have nowhere to go.
Yeah. So that's reason one, right? No new affordable housing. And then two, no one's listing their homes. And then three.
And then three is with interest rates this high and people not listing their houses, who could afford to buy a house? Right. So
you're saying reason one and reason two are going to lead to reason three, which is going to just put a halt to demand. It's going to slap all the prices of houses back down.
You're going to see, demand is there, but not at the demand for housing is real
not
in
the
this
price.
country, but not at the price.
That's why prices are so high. That's what the average price of a house now is, over $500,000.
People can't afford that. People cannot afford that.
But also in a rising interest rate environment. So
absolutely. So now it is more expensive to borrow more money. And if people couldn't afford to buy the houses when it was cheap money, they can't afford it when it's more expensive money.
Of course,
you're going to see. You're going to see this demand. And then what's going to happen is you're going to, and the only thing that's going to stave this off is you have these large institutional investors buying houses now.
Oh, yeah.
And that's, exactly. And that creates a very different problem.
But that's what I'm trying to say is like, I think, so first of all, I don't see a crash in housing prices unless interest rates go up above 5%. That's one. Because I think in this rising interest rate environment, I think the demand is still going to be there because everybody knows that like, hey, I mean, doves are dead. Yeah. So
they got hunted.
So they got hunted by the best hunters in the world. So doves are dead. We need to buy houses now. So that's going to drive demand up
now in the short term.
Yeah, in the short term, and then also home builder sentiment way down. Yeah. On top of that, if there is a correction, I think if there is a cool down in real estate prices in the US, I do feel like foreign investment and major banks like the BlackRocks of this world are going to come in and start buying up residential properties because BlackRock owns how many homes does BlackRock own? Like, or what percentage of residential homes does BlackRock own?
Institutional investors own 300,000 of the 15 million single family rental homes in the United States.
Oh, okay.
Which means that the 14.7 million other homes that are owned by individual landlords or smaller companies.
Yeah, and I get that investment in real estate. It's a fun. I think it's a phenomenal investment, but man, gosh, that's just
the issue,
man. Because it's like I think a lot of it like has to do with the fact it's kind of like the way you view futures trading. Like if you're not someone that actually is in the game that grows the crops, it's like why are you trading futures? But it's like I get it that you're providing liquidity to the markets. But it's like that could have been somebody's home that you're buying, like someone's home that they own. I mean, I'm not. It sounds like I'm really against investing in real estate, which I'm totally not. Like,
neither am I. I'm
very much for investing in real estate. But
I agree. I agree with you there. Yeah. The issue when it comes to real estate investing specifically,
I just think there's just a rush into this market. That's the reason why it's way worse than.
And here's the next part. Remember what the Fed was doing for the better part of 2 years.
Weren't they doing that thing where they put a lot of money into?
They kept buying
certain securities.
They kept buying MBS and driving directly tied to.
Oh, that's what it is.
So at the same time as you've got so remember this now. At the same time, you've got 0% interest rate from the Fed, so it's the lowest interest rates you're ever going to see.
Yeah.
I don't want to say hopefully, but hopefully in my lifetime, there is never a reason for interest rates to go to zero or negative again.
Well,
because that indicates a very severe problem.
Yeah, but it was already down to nothing or almost zero before there was a severe problem. And then when you had a severe problem, there's nowhere else to go.
There's nowhere to go, but the little bit left. Yeah, exactly. And that's a different issue. And I think we've definitely talked about that one, but I agree with you 100% on that. But so at the same time as you've got banks sitting here giving you these low interest rates, so you have people refinancing their houses, which is great. They can afford their home. They're refinancing. They're happy where they are. They want to keep living there. For those people, that was an amazing gift, and I'm so happy for them.
Yeah, me too. That's fantastic.
If you didn't,
what a great opportunity.
Yeah, it's one of those things where you're just like, well, have a good day.
Yeah.
But so at the same time as all this is happening, the Fed is buying MBS. They're buying mortgage-backed securities, taking them out of the market, pushing capital back into the same people who are issuing these loans, who are originating all these loans, who are creating these products, who are facilitating the purchase and sale of homes. And so at that point, you then see, okay, well, what happens when interest rates go up? They're already too expensive for demand to continue to exist at that level in a meaningful way. And the Fed starts to unwind and starts to sell those MBS back on the market, taking cash out. On top of the fact that the Fed is also going to be raising interest rates themselves throughout the rest of the year. So you're going to see interest rates really start to creep up. I think they will cross.
I think it might have to cross a lot more than 5%, in my opinion, for like the actual housing market to get sucker punched. But
I didn't say sucker. I didn't. Okay, fine. Is it going to crash? No. Will there be a major correction? Yes.
So what exactly do you mean by a major correction? Do you mean like a 5% decline in prices, or do you mean just like some sort of decline in prices?
I think 5 maybe.
Because I don't know. I think and this is weird to talk about the housing market like a stock, but it's just like
at least 5%. I'll say at least 5%.
Yeah,
it wouldn't surprise me if it was closer to 25%.
I don't know, dude, because I honestly, 25%. That's I mean, I hope so because I would like to buy a house soon.
Let's put it this way. I love my parents, and I love their homes and the places I grew up as a child. Counting for inflation and looking at like prices, I do not know based on like estimate values that I've seen because I've just looked because I randomly look at housing prices. I know Orlando is pretty bad.
I always do that. Yeah.
It's one of those things where I look and I go, I don't know if aside from the fact that everyone else is willing to pay that price, the home is worth that amount of money.
Yeah, but the thing is, I mean, the fair market value is what people are willing to pay for.
Is what the fair market's.
Yeah, I mean, it's like I had a cousin that sold her house recently, and she the appraisers went in there and said this house is worth $400,000, and then she got an all cash offer $450,000. Like, what are you gonna do? Like, who cares what the appraiser says?
Yeah,
all cash offer for.
Yeah.
If this person was taking on a loan, then you got to take the 400. But like, if they're gonna give you $450,000 cash, what are you gonna do? So
as long as I know I can buy another place for less money and I can afford it, I'm probably going to sell out and go.
Yeah, in this situation, took place a year ago, but like it's in that situation, it's like, I mean, I think enough of those things happening, it became this like kind of widespread thing that propped up the value of all these houses.
You had a lot of factors propping the markets up to record high prices, and I think now a lot of those factors are going away.
I don't know though, because I feel like there are so many catalysts towards, like I said, I'm talking about real estate like a stock, or the housing market like a stock, but I think it's going to meet resistance because I think what's going to happen is, first of all, commodity prices through the roof, not good for houses because, houses do use a lot of commodity.
Tend to be made out of commodities.
Yeah. Metals, lumber, right? Commodities.
So here's another.
Yeah, but the other thing too is this like the institutional investors, and I think that the foreign markets, I think that the global markets, I think are also going to swoop in. Like I said, man, like
I don't think you're so. But remember how foreign markets like to come into this. Foreign markets like to come in and they like to buy into REITs and they like to buy into.
But what does that do? They don't like to when they buy into REITs. Where does that money go? Where does that money go when they buy REITs? You know what I mean?
It keeps funneling back into the U.S. system in housing. I don't
so that's what I'm saying.
Well, and real estate doesn't
and whether or not they buy REITs or they give someone a ton of money to develop a community. Yeah. Either way, man. Well, I guess if they give someone money to develop a community, that's bringing supply up, which would kind of go the other direction. But maybe they could give.
Yeah, remember. So housing is that interesting thing where as you increase the supply of housing to make more housing available for people to own, you deplete the value in theory of other houses because they're not as rare, right? Yeah. You're increasing the supply. And so you have this really interesting position where people hate when their house price falls, but also acknowledge that there's a very serious problem, right? So you've got everyone who's sitting here, and it is unfortunately, because of the way supply and demand works, a zero-sum game in the short term. Yeah. In the long term, it's a non-zero-sum game.
That's because so tough to even.
While your house might come down $10,000, you are adding a new $150,000 house to the area. So it's like, okay, my house is now worth $10,000 less, but now more people are owners around me. And therefore, my community collects more real estate, more property taxes from owners. So therefore, maybe while my house may decrease in value, maybe my property taxes may also go down, and I might see a larger benefit. Yeah. So there's all kinds of game theory factors that come into this. But so in the short term, we look at housing and we see it as a zero sum game. In the long run, we have to look at it as a non-zero sum game.
Yeah, but I mean, okay. So even if interest rates don't reach 5%, what do you think? Do you think housing market is going to face some sort of correction?
I do, but the thing is, so this is why. So it's a weird thing. So I don't know. I think it will because I think you see the Fed start. You said the Fed unwind its position. You see interest rates go up, and when fewer people can buy fewer houses, I realize that it all depends. If there are fewer people than there are houses, right? So if the demand shifts left by a greater margin than supply shifts left, you'll see prices go down. Yeah. Whereas if it's the other way, proportionally, prices will go up. But I think what'll be interesting is I don't think a lot of people are going to be selling. Which is the thing, because
that's what I'm saying. Like, what does fewer people selling do?
Do you want to know the really morbid reason that there may be a housing issue that we might see a major sell off? The baby boomers don't have that much time left in them.
So
my parents' generation is very old, and I'm saying that there are two things that are going to happen. this is morbid. I don't like, I'm not like,
but it's an economic cycle.
They are a generation that is one dying off at a faster rate than really any other generation. And then obviously they're older. And then the second part is a lot of baby boomers are downsizing. They're moving into smaller condos so they don't have to maintain yards. They're moving into smaller properties, retirement homes, so they don't have to deal with nursing homes because they can't keep up with themselves. Remember, this is a generation that's at this point they're in their 70s. They're in their late 60s and 70s, and so it's
tough to think about.
They're in a position where
that's my parents' generation. I don't want to think about it. But it's true. It's an economic cycle.
It's my parents too. But suddenly think about it, like you live in Dallas, your parents are in Arizona. I live in Nebraska right now. My parents are in Florida, and if I was, if you're living in a place that's away from your parents and you are established there, and that's where your life is, that's where your work is, and you're not going home, you're probably not going to hold the property. You're probably going to sell it. And so it's this.
Yeah, I mean, that's a good point. That's a really fascinating way to look at it. You know what I mean? Because I think, when it goes into a state, it's, like this house is owned by these three kids. Like, what are they going to do? They're not going to all three of them own the house. They're going to put it on the market.
Either put it on the market, right, take their share.
$600,000. You each get $200,000. We each get $200,000.
In some cases, you might see them partner up to try and rent the house out. In other cases, you might say that one of the kids wants to live there, and so they say, "Well, I'll buy you two out as we go."
Yeah, but I would say the majority of it, like, they don't want to worry about it anymore, right? Like, unless it's just like a sentimental thing where, like, they want to keep this house in the family.
Yeah,
I'd probably say it's like,
statistically speaking, you're going to see these houses entering the market.
Okay, well, that's one way to look at it. I
hate to say, but that is where so I guess the youngest baby boomers are 55, but the oldest baby boomers are in their mid to late 70s, right? So this is a big generation of baby boomers.
The average life expectancy is around mid 70s in the U.S., right?
Yeah, 72 to 76, I think, depending on male or female.
But yeah, exactly. I was going to say male or female.
So as you see that generation downsize and die, you're going to see the supply of homes reopen. And the next problem is specifically for like the baby boomer style home, which is that suburban home with the white picket fence and the large yard that requires a lot of maintenance and all these other things. That is not a home that as a whole, the millennial or Gen Z want to buy and own. They look at that and they go, while I enjoyed kind of growing up there, I don't want to deal with all these other things. I don't see it as this hallmark of home ownership. Okay. The value of that to them isn't there in the dollar amounts. Yeah. And that's what's going to happen. I think that's what's going to happen.
Yeah, I know, I still think, I don't know, like that aspect of it, like, and I think that theory works mainly with like parents of millennials that maybe already own a home or are happy with their current living situation, whether they rent or, whatever it is, right? I think that's where it applies. I mean, and obviously, like, I do think baby boomers are a big part of obviously they're a massive part of our population as a whole, but
they're smaller than millennials now. So
right. So that's what I'm saying. Like, as a whole, like in the housing market, like, I mean, and I think because it's not going to happen all at once. If it happened all at once, absolutely correct.
There's a different issue. Yeah.
So I think because I think it's going to happen over time, right? And some of these guys, hopefully, like my parents, hopefully will live till they're 150 years old. So
careful what you wish for.
That's actually a really good point. But it's stuff like that, right? Like it's just, someone could live for a long time, like, I mean, my grandpa, my dad's dad is 104 years old, still kicking it, still playing chess. So there's good odds. So my hope is that I hope my dad at least lives for another 40 years. That way I'm at least 70 years old before I have to worry about him.
To deal with that.
Right? Yeah. My dad's dad takes care of himself, doesn't need help with anything, Give him a meal every now and then, but he doesn't need help with anything.
That's what the holidays are for.
Yeah, exactly. But that's a great perspective, right? It's something that I never thought about. And I do think in the long run that will possibly contribute to a correction in the housing market, but I don't think it's going to be as severe as some of the supply shocks that we're seeing, as some of the commodity, the impact of commodity prices.
No, I certainly agree with you that the lack of supply has been propping up the home price.
Yeah. And the last thing I'll say too, and I'm sorry to just interrupt you right there, but these transactional real estate, like these mortgage companies that are really dependent on transactional like the refinancing companies, like they base their business on, we need a bunch of transactions. We need people to refinance over and over and over again. And because refinance demand looks like the Russian ruble a month ago.
Yeah, why would I refinance now when there's a higher interest rate than I did 2 years ago? You're out of your mind.
But I think a lot of these guys have exposure. Like a lot of the companies that are in the business of refinancing, that their business model is based on that transactional, hey, like 10 people came in and refinanced today. What a great day. Like those companies, those businesses, because they know that they're going to be lacking in that refinancing department of their portfolio, they're going to look towards other things such as giving out new loans, new mortgages. So I think they're going to start being more flexible on, maybe they will. This is just a complete guess because I don't know anything about real estate and mortgages.
New housing, that's possible.
So that's what I'm saying. Like they might start only requiring 5% down, or maybe they already do that. I have no idea.
Well, that's where you start to run back into like, well, can people really afford these homes again? But which is an interesting question.
Yeah,
but
so it could lead to another housing bubble. But
it could
just a speculation.
Well, the great thing. Do you want to know a home you can have that doesn't require any refinancing, any mortgage, anything else?
Or any fixed income payments?
Any fixed income payments, nothing. Wow. A one-off payment.
What would that be?
It's a hoodie from Drunkenomics.
Oh my gosh. I bet they come in black and even darker black.
They do. Just like Henry Ford said, Henry Ford didn't say it comes in any color as long as it's black. But you can check them out at drunkenomics.myspreadshop.com. And
that's
you
exactly
too
where you can check it out. Yeah.
Can find a home with us here at Drunkenomics.
Yeah, exactly. And speaking of finding a home, you can also join our Discord. That's free to all. It's like Fight Club, free to all.
Free to all. First time
bad analogy, maybe. I don't know.
Your first time here, you don't have to post. Yes. We appreciate if you do.
Yeah, and if you post, you don't have. You can have your shirt on. It's fine.
Feel free.
Yeah. But, feel free to join us there. Like I said at the beginning of the episode, at Drunkenomical, follow us there. We love hearing from you guys. So seriously, whenever you want, tweet at us, slide into our DMs. It makes James's day. And not very many things do make James's day, except for when he has like a nice string of sneezes.
And here's the worst part. It was about to happen, and then it stopped again.
Oh my gosh, dude. Again? That's how you're going to start and end this episode?
I was really hoping. There was a point where about 30 seconds ago, I was like, I think it might be about to sneeze. And I was going to be like, it'd be hilarious if I ended the episode with the sneeze. And of course,
nice.
I stand corrected.
And you know what, guys? Nice. Wow, that's two really good ones. And you know what? If you want to help James see an ENT specialist, you can always go to patreon.com, patreon.com/drunkenomics. DRUNKENOMICS. From there, you can, along with helping James see an ENT specialist, you can
help us keep the lights on, liquor cabinet stocked. And it's going to be harder now than ever, obviously, for both you and us to keep said liquor cabinet stocked with the rise in corn.
Yeah, come on, man. So like, look, why you gotta do that to us, man? But whatever. I mean, with that said, I don't know. Does it get worse? Does it get worse?
I'll be honest. Unlike the housing market, which I think will get worse, a good drunkenomical time always gets better.
It really does. As long as you play chess, not checkers. Don't brag. Just say. Always remember to fill and kill, but most importantly,
stay drunkenomical.
Cheers, my friend.
Cheers.